Forecasting within the context of capital budgeting. One of the interesting things about capital budgeting exercises is that we depend on forecasts to create our cash flows. So based on that, poor forecasts are going to lead to poor net present value and poor internal rate of return and poor payback analysis. So we need to have the best forecasts possible. Generally, when we're talking about forecasts, we always begin with a sales forecast. And sales forecasts are sort of the foundation for forecasting everything else, whether it be operating income and profit, or whether it be manufacturing and production schedules and helping to estimate costs. Those things are all driven by sales forecasts. If you have an existing business, this is a little bit easier because you probably have historical sales data. So you can look at your existing business and you know how much sales are coming in and how much sales are likely to be impacted by making a new investment. Sometimes things change and there are things that we need to consider in our environment that might impact our sales. We should consider changes in the competitive landscape and changes in our own strategy as part of those things that might impact our forecast based on our existing business model. But generally speaking, existing companies, because they have historical sales data, usually have at least something to begin working with when they start trying to figure out what's going to happen if they make the new investment. Startup businesses have more difficulty with capital budgeting analyses because they don't have historical sales data. So one of the things that we're trying to do is estimate what's going to happen, and because the company has not been selling, we don't have a whole lot of data to work with. Sometimes this can be a problem in an existing business that's just looking at launching a new product category, in which case you'd have to treat it as if it were a startup. One of the things that can be very helpful when we're doing forecasting in a context where we don't have historical sales is we can look at sales from someone or something else that are comparable. And maybe it's not something that's exactly the same as what you're selling, but it's very similar, or perhaps competes for the same dollar. And you might be able to find a number of other organizations out there that are selling and figure out a forecast based on the level of sales of those other organizations. Sometimes competitive sales are very helpful. That's someone that's selling exactly the same thing that you are. And you can at least build sort of a framework or a case for a certain level of sales forecast based on what the competition is doing. In some cases, organizations are able to pre-sell things, and you can indicate how you can sort of get an indicator for how much demand there is by collecting pre-sales data. For example, if you say, hey, look, we sold 5,000 units in advance, there's fairly strong demand. Those 5,000 units were sold very quickly without hardly any effort on our part. Gives you a better feel for what might occur once you finally begin to launch the project. Cash flow for capital budgeting analysis really comes from two sources, and that's either from an increase in sales or a decrease in costs. Interestingly, sometimes it can come from both in the same project. You might invest in a machine maybe that increases your capacity so you can sell more, and it might actually decrease your unit cost. Or in some cases, it only does one or the other. So you have to consider both and make sure when you look at a project that you are looking very carefully at expenses as well as sales. Remember that we're only looking at dollars that our company collects in the form of cash flow that happened because of the new investment. We cannot include in our analysis any dollars that were already going to occur whether or not we made the new investment. This is called incremental revenues or incremental savings, incremental cash flow, and it's got to be because of the investment. One useful exercise since we're doing forecasting is to do something called sensitivity analysis, where we change our set of assumptions and then look at it again. So for example, you might say, okay, look, we're using this set of assumptions and this is what our net present value looks like. And then now we're going to rerun the data under a more conservative set of assumptions and say, what if those things don't really work out for us? What if it turns out that our sales are only a fraction of what we forecast they were going to be? What does that do to our net present value? It's a very useful habit to get into. It shows a lot of maturity as a business person to look at things from different angles. You can come up with an aggressive forecast, a moderate forecast, a worst case scenario forecast, and you might run net present values under all three sets of circumstances so that you at least have a framework under which you can make decisions and say, okay, what do we think is most likely to happen, and what's the result going to be here.